The world didn't collapse in 1929 because of greed. The real reason was that people believed too much. They believed in markets, in prosperity, in a system that promised endless growth. But when faith mixes with debt, it becomes the most dangerous illusion in history. October 1929 was no accident. It was the day faith turned against its believers. The final hours, Monday, October 28th, 1929, began like any ordinary workday. Businessmen in Manhattan took the subway to their offices, reading headlines that said, "American prosperity will last forever." Secretaries typed letters about record profits. Bankers counted deposits that seemed to multiply like magic. Everything appeared perfectly fine. Across the nation, families were making vacation plans, buying new cars on guaranteed credit, and watching their stock portfolios climb toward the sky. No one realized they were living the final hours of the greatest economic illusion in American history. No one understood that the same confidence that had made them rich would, the very next day, destroy everything they owned. The crash of 1929 wasn't an accident or bad luck. It was the inevitable end of a 10-year financial dream. An entire nation had convinced itself of one idea. Prosperity is permanent. Debt is harmless. Markets will always go up. But the real story isn't what happened after the bubble burst. It's what happened right before. How intelligent, educated, rational people managed to convince themselves that this time was different, that the old rules no longer applied, that the party would never end. And the irony is, the same delusion that destroyed fortunes in 1929 never died. It just changed its disguise. And in every new era, in every new bubble, it came back again and again. The prosperity and the delusion of the 1920s. The 1920s weren't just years of prosperity, they were intoxicating. America had emerged from World War I stronger than ever, becoming the world's main creditor. Its factories were booming, its banks overflowing with Europe's gold, and for the first time, ordinary workers could afford the luxuries their grandparents only dreamed of. Radios, automobiles, refrigerators, washing machines, things that once belonged only to the wealthy were now entering the homes of the middle class. Henry Ford had perfected mass production, selling cars at prices almost anyone could pay. Thomas Edison's electric grid lit up cities from coast to coast, turning night into day, and all of it was made possible by one thing: credit. That magical phrase, buy now, pay later. People began to feel rich, and once they felt rich, they started living like it. And the more they lived like it, the more the markets made them feel rich in return. The stock market became a national obsession. Barbers gave stock tips between haircuts. Taxi drivers talked about their portfolios. Homemakers pooled their savings to buy shares in companies they'd never even heard of. The market wasn't just an investment anymore. It was proof that America had discovered the secret to endless wealth. Between 1924 and 1929, the Dow Jones tripled. Stocks bought for $50 in spring were worth $150 by autumn. Anyone who got in early looked like a genius, and the real engine behind it all was credit. Not just loans for cars or appliances, but borrowed money for buying stocks themselves. It was called buying on margin. You could buy $100 worth of stock with only $10 of your own money, and borrow the other $90 if the stock went up. The profit was all yours. If it went down, well, no one liked to talk about that, because everyone believed one thing: stocks only go up. By 1929, margin debt had reached $6 billion, over $90 billion in today's money, and all of it depended on one fragile belief, that prosperity would never end. But like every belief, this one was dangerous. Every success story fed a new delusion. Joseph Kennedy made millions. Jesse Livermore became a legend. Magazines printed headlines like "Everyone can be rich" and "The permanence of prosperity." Even America's top economist, Irving Fisher, declared, "Stock prices have reached a permanently high plateau." The experts had started believing their own propaganda, but beneath the surface, the cracks were already there. Company profits weren't growing fast enough to justify stock prices that had tripled. Unemployment was creeping up. Farmers were going broke. Europe was still struggling to repay its war debts, and the Federal Reserve, seeing the speculation spiraling out of control, began to raise interest rates. Borrowing became harder. The whole system started to wobble, but no one wanted to hear it. The noise of celebration drowned out every warning. Radio shows covered the market like a sports event. Newspapers told stories of ordinary people getting rich overnight. Stores were packed with customers spending money they didn't really have. The entire economy was now running not just on consumption, but on belief. The belief that it could all keep expanding forever, and that belief rested on one fragile assumption: stock prices would never fall far enough to threaten the system itself. The cracks begin, but every party ends eventually. And by 1929, that glittering celebration was starting to fade. The stock market was no longer just a playground for the rich. It had become the foundation of middle-class wealth. Teachers, clerks, factory workers, all had poured their savings into the market. Believing they were investing in America's future, banks accepted those stocks as collateral and issued billions in loans against them. Companies even used their own shares as collateral to borrow money for expansion, tying their entire future to a market that everyone assumed would rise forever. The whole system now looked like a house of cards, each layer holding up the next. And those cards had begun to tremble. By September 1929, the warning signs were clear. Some stocks began to fall sharply, then bounce back, just enough to calm people down. But those little dips were the first cracks before the collapse. Brokerage firms started asking clients for more margin money. The so-called smart money, or the insiders and professionals, were quietly stepping aside. But no one noticed, because the charts still pointed upward. For months, economist Roger Babson had been warning, a crash is coming. People laughed. They called him a pessimist, a man who'd simply missed the biggest opportunity in history. By late October, the market was exhausted. Professional traders could feel something breaking, but no one knew when. Ordinary investors, meanwhile, saw every dip as another chance to buy the bottom. Brokerage firms kept lending because the commissions were too good to resist. And newspapers kept selling optimism because hope sold better than truth. The stage was set, but no one wanted to believe that the show was about to end. Sunday, October 27th, families went to church. At breakfast, they read the financial pages. Children played in the yards of new suburban homes bought with stock profits. Parents talked proudly about college funds that seemed to grow by themselves. And in the back of everyone's mind was the same unshakable confidence. They had found the secret their parents had missed. A formula for wealth without risk. A belief that the market would always reward faith. But on Monday morning, that faith would face a test no one was prepared for. Black Monday, October 28th, 1929, Monday morning, Wall Street felt different. The usual rush was there, men in suits, paperboys shouting headlines, taxis honking down Broad Street, but the air carried something heavy, something no one could quite name. It was the kind of silence that comes before a storm. Veteran traders recognized it, but most brushed it off as just another Monday. At 10 a.m., the opening bell rang, and within minutes, everything changed. After months of steady gains, prices no longer moved with confidence. They swayed, like a drunk man trying to keep his balance. General Electric opened lower. RCA stumbled. U.S. Steel began to slide, and a nervous murmur spread across the trading floor. But still, no panic. Everyone had seen dips before. They believed the pattern would repeat. A quick fall, then a strong rebound as the smart money jumped back in. That had been the story for 5 years straight. A brief scare, then another record high, but not this time. Because this time, the smart money wasn't buying. It was leaving. Professionals were quietly unloading their stocks, while the small investors kept saying, "This is just another buying opportunity." But the pros could read the signs. They saw trading volume spiking. They saw buyers hesitating. They saw margin calls piling up, and they knew one brutal truth. In a leveraged market, confidence isn't just important, it's everything. And that confidence was cracking. By noon, the decline was impossible to hide. Stocks that had dropped a few points in the morning were now down 10, 15, 20%. Ticker tapes fell hopelessly behind. They were printing prices from minutes ago while the market fell faster than the machines could record. Brokers called clients asking for more cash. Investors scrambled, desperate to find it. Each sale drove prices lower, triggering more margin calls, forcing more sales. It was a chain reaction, a spiral with no bottom. By afternoon, panic had arrived. Investors were crying on the phone, begging banks for help. Bankers realized the loans they'd made that morning were already worthless by evening. Brokers, exhausted and pale, watched client accounts vanish in real time. By the closing bell, the Dow Jones had fallen more than 12% in a single day. Some stocks had lost 30, even 40% of their value. Billions in paper wealth had vanished. Not transferred, not stolen, just gone. And still, many refused to believe it. Newspapers called it a sharp correction, assuring readers that the fundamentals are sound. Politicians urged calm, saying there is no cause for panic. But that night, millions of Americans went to bed uneasy. They hadn't just lost money, they had lost faith. Because the stock market, for them, wasn't just about profit. It was a symbol of the future, of hope, of belief in progress. And that belief, for the first time, had cracked. Black Tuesday, October 29th, 1929, Tuesday morning. The city was silent, almost unnervingly so. The sun rose over Manhattan just like any other day, but beneath it, the world had changed. There was a heaviness in the air, as if everyone already knew what was coming. Across America, people sat at breakfast tables, clutching their newspapers with trembling hands. They were looking for comfort, but found only confirmation of their worst fears. Overnight, European markets had collapsed. London had taken heavy losses. Paris had just lived through its worst trading day in decades. The wave had crossed the Atlantic. And even before the New York Stock Exchange opened, everyone knew Monday was only the beginning. This was no longer about numbers. It was about people. Families sat in silence, realizing their children's college funds were gone. Workers who'd saved for years watched their retirement dreams evaporate overnight. Small business owners understood their stock-backed loans would destroy them by morning. The American dream wasn't just delayed, it was erased. But the real danger wasn't the losses themselves. It was what those losses triggered. Banks discovered that the billions they had lent were now backed by worthless shares. Insurance companies saw their reserves collapse. Corporations watched their collateral vanish as stock prices plunged. The foundation of prosperity, borrowed confidence, had disappeared in a single night, and psychology flipped completely. For years, investors had said, every dip is a buying opportunity. Now they whispered, every rise is a trap. The same confidence that had built fortunes was now destroying them. At 10 a.m., the opening bell rang, and chaos exploded. Sell orders flooded the floor like a dam breaking. General Motors down 20 points, Westinghouse down 30. RCA, once the pride of America, was falling so fast the ticker couldn't keep up. The tape machines ran minutes behind. Investors couldn't even see how much they were losing. 16 million shares changed hands, a record so high the system simply broke. Just days earlier, the stock exchange had been called the pride of modern finance. Now it looked like a battlefield. On the trading floor, chaos reigned. Secretaries answered phones filled with screaming voices. Brokers tried to calm clients, but there were no words left to soften the truth. No one knew how much they'd lost, only that it was everything. From the gallery above, spectators watched the collapse of American capitalism with stunned silence. Margin calls hit like an avalanche. Accounts were wiped out. Each sale drove prices lower, triggering more sales. A self-feeding death spiral. Even the banks couldn't breathe. Collateral had lost half its value. Depositors were starting to lose faith. Institutions once thought too strong to fail were suddenly staring at ruin. The crisis was no longer just a Wall Street problem. It had reached every corner of the country. Small-town banks began to fail. Farmers couldn't repay their loans. The credit system collapsed, and with it, trade, production, and jobs. By midday, the nation's top financiers met in emergency session. J.P. Morgan Jr., Thomas Lamont, and other banking giants gathered to try and stop the bleeding. But the selling wave was unstoppable. No amount of money could fight panic, and the irony was cruel. The same leverage that had built the boom was now magnifying the crash. The same system that had made people feel wealthy was now destroying the illusion it created. By late afternoon, the truth was clear. This wasn't a correction. It wasn't even a crisis. It was the total collapse of a structure built on debt, time, and trust. October 29th, 1929. A date that became a warning written in history. The day a nation learned that prosperity built on borrowed faith isn't prosperity at all. Paper fortunes burned faster than paper itself. People who went to bed wealthy on Sunday woke up on Wednesday with nothing. And they learned the hardest truth of all. Markets don't reward belief forever. Eventually, belief is tested. And most of the time, it's punished. The bigger the bubble, the harder the fall. The collapse of trust. But the most important lesson of 1929 was never written on a stock chart. It was written in human nature. The crash wasn't an accident. It was the result of the oldest lie humanity keeps telling itself. This time it's different, and that lie keeps coming back. It never disappears. It just changes its clothes. Sometimes it's real estate. Sometimes it's tech stocks. Sometimes it's crypto. Sometimes it's government debt. But beneath every version lies the same story. The old rules don't apply anymore. The system can go on forever. Prosperity is permanent, but it never is. The crash of 1929 wasn't just a financial disaster. It was an awakening. The nation realized that wealth built on confidence was just a dream written in fragile ink. And once that confidence cracked, the whole illusion fell apart. Because an economy isn't made of money. It's made of belief. It's the belief that a piece of paper has value, that a bank can create money from that belief, that a nation can buy its future with the same faith it once used to build it. But trust is the most fragile form of currency. And once it's broken, there's nothing left to replace it. That was the cruelest lesson of 1929. When trust collapses, it doesn't just break the economy, it breaks the heart of society itself. History doesn't repeat word for word, but it always punishes those who ignore its warnings. In 1929, in 2008, and one day, again, because systems change, but human nature doesn't, and when that day comes, people will say it again. This time is different, and history will whisper the same reply. No, it never was. If this story gave you a new perspective, don't forget to like the video and subscribe. Because the answers are already written in history. I'm just here to show you where to look.